Regional Manager with the Washington State Small Business Development Center and a certified business advisor. I was lucky enough to take this webinar back in November, and I found it very, very informational. So I wanted to spread this information to our community. And thank you very much, Steve, for taking the time to do this for us.
Let me dive in with a little preamble. So Gail Schnee is our business recovery coordinator here at the EDC. You probably know me and Mickey. Mickey's our trades coordinator. I'm the director of the EDC. And anything that you need for your business, feel free to call us or email us anytime, because that's why we exist, essentially, to help small businesses and to help drive our economy. And I wanted to do a quick public service announcement about the EDC's event called Data Palooza. It's all the data you can stand in a 1.5-hour format. And it talks about our economy, the things that happened over the last year or two, and expectations for the future. And you can get tickets for that at our website, sanjuansedc.org/datapalooza, DATAPALOOZA. So thanks, Gail, for letting me dive in with that quick public service announcement. I also wanted to mention that we're recording. So if you don't want to be part of the recording, you can turn off your video and change your name if you want to be completely private about it. But we will probably be posting this on our website for folks who aren't able to make it today. So thanks, Gail. And thank you again, Steve, for coming today. We're really excited that you're able to bring this to us.
Sure thing. Well, thank you, Victoria and Gail. I'm delighted to be here. Let me give everybody just a little bit of an update or insight into who I am and who I work with or for. We're part of a group called the Washington Small Business Development Centers. The SBDCs are actually a nationwide group supporting small business owners. Created originally by Congress in 1980, so we're just now into our 42nd year here in Washington. In that original charter with Congress, it's created as a federal local partnership with the local being administered on the sort of the state level side by institutions of higher education, originally land-grant colleges. The only land-grant college in Washington is Washington State University. So I am actually an employee of WSU. And we do have some management oversight on the federal partner side of this from the U.S. Small Business Administration. So relative to this federal local state partnership, we are full-time year-round paid professionals. We currently have, and I'll show you a map when I'm done today, 27 locations around the state of Washington with almost 40. We do have some vacancies, but when we're full, almost 40 certified business advisors that are available to help all of you. I have been to the San Juans many times and hope that we can establish a further connection with all of you over time. So I'm really delighted to be invited to do this presentation for you. We do one-on-one, face-to-face advising. Since COVID, most of that has been virtual. And we've also been doing a lot of training and webinars, really several hundred just in the last 2 years as a way to really truly get basic business practices through to people. So without me trying to really understand each of you and your businesses and how they work, because you're kind of here more to hear from me than I am from you. But I'll say that if any of you want to reach out to me afterwards and talk about this stuff, I'm more than happy to show you how to get to me or to anybody else that might be in our organization that you would rather meet with. I've been here for 12 years. I'm actually the Western Regional Manager, so I'm responsible for all of our advisors on the west side of the Cascades in Western Washington. And I've worked with several thousand small businesses over the last 12 years. And what I'm going to share with you today are some of the very basic things that we've learned about how to be truly most successful Some of the things that I'm going to share with you might surprise you. Some of the things that I would almost expect you to say, my goodness, how am I going to do that? But when I talk about financial discipline as a system, I'm really talking about ways to develop a system so that it doesn't consume all of your time. It's going to potentially, depending upon who you are in your business, kind of cause you to sort of step away in a sense, or at least in terms of your thinking about the way in which you may be operating your business. It may not, but with most people that I present this to, they think, wow, do I really have the time and the ability to do this every single week, 52 times a year without fail? Well, we'll talk about ways in which if you're spending too much time on it, you're probably doing the wrong thing. So we'll talk about that. But the first thing I want to talk about is some facts and statistics, most of it from the Small Business Advocacy, which is the SBA Office of Advocacy, who does basically research on small businesses. We're going to talk about some basic facts about those. So first one, as a matter of reality, 80% of all small business starts nationwide fail at some point in the first 5 years. What most people don't know, that statistic is actually somewhat common knowledge, but what most people don't know is that of the 20% that make it, 80% of those fail in the second 5 years. There's an awful lot of businesses, 8 or 9% of those who actually start originally to get a business license, who do make it. Of that 8 or 9% that can be profitable through 10 years, the reality is that about 75% of those are what we refer to as a lifestyle or a hobby business. The definition of a lifestyle or a hobby business is one that is solely dependent upon the owner. If the owner gets hit by a bus, the business ends immediately. It typically doesn't have the capability, because it was all about the owner, to move on to someone else to take it over. There are a couple of other criteria, and again, this is generally speaking, it may not specifically apply to your business, but generally speaking, one of the things that we know is that in a business that is solely dependent upon the owner, when the owner is no longer able for whatever reason to operate that business, the business isn't actually worth anything. There may be some inventory, there may be some, accounts receivables or something, but typically beyond that, the actual value of the business that was all about the previous owner no longer has that same value. And it's very, very difficult to sell that kind of a business. More often than not, they just close down and whatever value they may have had in equipment or inventory oftentimes gets lost or just gets sort of portioned out through other legal means. The other thing, though, too, is that we've learned that for a lifestyle or hobby business, and I should preface this by saying there's honor in a lifestyle or hobby business, right? Of the 75% of active businesses that can get through 8 or 9 through 10 years profitably, we know that those folks typically who operate those are doing what they love to do. So there's true honor in those types of businesses when they are doing what they want to do, and they really want to focus on just that. Taking a vacation isn't necessarily something that appeals to them because it takes them away from what they love to do. So we do know that oftentimes these businesses are working 60 hours a week or more, and that of those, difficult to take time off, put in an awful lot of work, dependent upon the business owner, and at the end of the day, really aren't worth anything as a business that they could potentially sell and even use as a retirement. Most often that's the case. We also know from the SBA Office of Advocacy that 81% of all US businesses, those with business licenses, actually have no employees. Surprising number, but it actually has been shown numerically and statistically based on business licenses, because anybody who gets a business license and hire employees has to register with the IRS to get an employer identification number. So we know all of those businesses in the US that get a business license with their state, and then we know which numbers of those actually identify to the IRS and hire employees and pay them direct wages. So if you are going to ask yourself, what's the difference between a lifestyle or hobby business? The other side of the coin, if you will, is what we refer to as a business of value. I'm going to share with you right now, essentially what that is. By the way, I forgot to mention when we got started, any of you that have questions about what I'm talking about, and I'd encourage you to, feel free to put those in the chat. I want to get through all of the slides that I have, but I'm more than happy to address any of the questions that, that you want to bring up before we're done in an hour. And I'm more than happy to have a conversation with you about any of those. So what constitutes then a business of value? Well, a business of value is one of those that is not necessarily dependent upon the owner, that has the real potential to get through 10 years profitably. And at the end of the day, when you go to sell it, somebody's going to pay real money for it. I learned this list when I was doing this work during the Great Recession from a business broker who was involved in helping clients during that recession when we were losing even more businesses than we're losing now. Through that recession, what should a business look like beyond just its financials if they want to sell it? Or if the business broker has a client looking for a business to buy, what they should be looking for. So one is where it's obvious that the owner works on the business, not just in the business. The second is where a business where the owners are working less than full time. The third is where there is a consistent growth and a well-established history. Lastly, a business where there is a diversified customer base. And in fact, a diversified customer base and two down where it's a niche service, the most successful businesses overall are very niche businesses that appeal to a lot of people, right? And a niche business oftentimes is one where there's a significant barrier to entry, trade secrets, intellectual property rights, that sort of thing. So when you take a look at what is typically and consistently considered to be a business of value, one where owners are building business systems like the one I'm going to discuss today, so that they don't have to do all of the work in the business. Certainly not something that every business can do, but if you are operating your business and you really want to take time off, most of the true real work that gets done in a business is through the work of other people that allows a business owner to develop a system, tweak and manage that system so that they don't have to be working in it all the time. Where there's a consistent growth and a well-established history is one in which the business is actually doing that consistent growth, has a well-established history, isn't going up and down and chaotically relative to its operations and its finances. If it is going up and down, the indicator there is that the systems, if they exist, don't actually work very well. Another one is where there's a limited reliance on any key employee. Key employees are important, but if that key employee, and I've had several clients over the years who have had a key employee who chose to leave or quit, or they got, hit by their proverbial bus, then all of a sudden the business is in serious trouble because the owner had too much reliance on that key employee and had essentially no ability to replace that person or to continue to do that work when that person is no longer around. The last one on this list, and I've kind of bounced around a bit, but the last one is a business where there's no perceived skeletons in the closet. It just so happens that the three most common causes or three most common skeletons in the closet are also the three most common causes of failure of a small business. The first one is a failure to collect all the money. This typically refers to a service-based business or a wholesale business that has to invoice. It's hard enough to be in business, but it's even harder to be in the collections business. And we meet with people all the time who's just don't have the time to manage their accounts receivables, aren't collecting their money, that sort of thing. The next one is a failure to manage the inventory. In this particular case, it mostly applies to a product-based business, where the first one typically applied mostly to a service-based business or a wholesale business. But in number two, there is an element of inventory that applies to a service-based business, and that's the capacity. If you are a business owner that provides a particular service as your primary product, there's only so much that you can do if you're the primary person providing that service. Professional services, IT services, accounting, bookkeeping, all kinds of services are available. And people do, but do they work 40 hours a week? If so, and or do they have any employees? What's the total possible capacity of everybody involved in the business? And are you measuring the extent to which you are running at full capacity? So if you've got 2 or 3 people, you can be working, say, 120 hours a week. 20 hours maybe, or 15 hours of that is for administrative time. Do you have the ability to apply all of the remainder time to people who are going to pay you for that service, whatever the service is that you're doing? So it's the overall capacity, and measuring how you're doing on that is a key metric for inventory in a service-based business. And the last one, which by far is the most important for all of these, and that's managing the business based on how much money's in the bank. I often ask people, how often do you check your bank account? Oh, 8 or 9 out of 10 of all the clients that I meet with for the first time will tell me that they are checking their bank account every day. Problem with that is that cash and cash flow isn't dependent upon just what's in the bank today, because it doesn't tell you what you owe, or it doesn't tell you what money is coming in. It just tells you what's there. And you have to kind of make a guess at the difference if you don't otherwise keep financial reports and update them every single week. And why do you want to update them every single week? We're going to talk about the financial reports in a minute, but why do you want to update them every single week? Well, if you update them every single week, the data in those reports can be as old as 14 days, and you might actually have a chance of finding where there's errors or there's problems. Many people do it once a month, and in fact, there are many people who not only do it once a month, they do it less frequently than that, like once a year when they have to do their taxes. The problem is that if there's a real problem going on with the business that really only shows up in the financial reports, if they do it every 30 days, produce and look at these financial reports every 30 days, then the information can be as old as 60 days based upon how the cycle works. Very hard to go back that far and find and solve a problem. There's way too much going on, way too busy. That's why, and I'm going to repeat this a lot, doing this on a weekly basis, only applying 90 minutes once a week, but utilizing a system so that you don't have to spend more time is what we consider to be by far the best practice. So I've talked about what makes a business successful, whether you're a hobby or lifestyle business or a business of value. There really are 3 things that our research over the years has shown that is the key to making the difference between those who are truly successful and have the best shot at getting a business profitable through 10 years and those who don't. The first one is having the desire to constantly collect data, do research, seek mentors. Even those people who are successful after 10 years, they're still saying, what's going on with the economy, my industry, my customers, my vendors, my employees. They're constantly collecting information about that. It's really the big thing today is data. Most of you know that. The extent to which you pay attention, do the research, seek that data, also seek mentors, much better chance at success. never coming from the position that you know how things work and that's the only way it's going to be. You want to be able to collect this information so that you can intelligently and successfully make changes to your business, tweak your systems, or even pivot to something else. Number two is the understanding that the owner's primary job, and I've mentioned this a couple times already, to create, manage, and tweak those business systems. So these two things lead to the third, that is the deal breaker for most people. And that's having the desire to have at least as much fun studying, learning, practicing, and refining that completely separate set of business skills that can be applied to almost any business. In other words, the reality is that you're a lot more likely to be successful over the long run, regardless of what kind of business you have, if you are willing to think of yourself as a business person who is a practitioner of independent, separate business skills as much as whatever the business that you have is about. There's a book called E-Myth Revisited by Michael Gerber that specifically describes almost everything I've presented to you already today. The E-Myth is known as the entrepreneurial myth. And the entrepreneurial myth is that someone who is good at or passionate about something can also run a business. This book, The E-Myth Revisited by Michael Gerber, and we asked most of our clients to look at it. Looks like this. I just met with a client today that I recommended the book to, and she'd read it just in the week since we'd met. And it is available today from the library, from Amazon Audible, from Amazon, from your bookstore, from Half Price Books. It's dated, I'll admit, but it is the only book that's ever truly been published that talks about how do you get, depending upon what it is you want to do, but how do you build the business systems so that the business isn't always dependent upon you? So that if you needed to take a break, you got sick or whatever, or even wanted to take some time off and go do something, you can still run your business rather than shutting it down. So it's about a woman named Sarah who's working 60 hours a week baking pies and can't even bring home enough money to pay the rent. The book steps you all the way through the process of what Sarah's goal was to open up 5 or 6 other pie shops so that she could spend time working on the business, managing all of those systems so that those separate pie shops could run independently and she could take time off and or work less than full time. So now that we've covered those as sort of the beginning element of the financial discipline system, let's dig in to the financial discipline system itself. And the first question is, how often should small business owners review and analyze their financials? Well, I'm going to suggest and demonstrate why you should do this weekly, 52 times a year without fail, even if you are on vacation. One of the things that we've learned, and I alluded to this a little while ago, that the success rates of businesses that produce and review their analyze their financial reports annually when they give it to their CPA for accounting actually have the lowest chance of long-term success. If they do it monthly, as I said, very difficult to resolve data that's as old as 60 days, but they do increase their chances of being successful in the long term. Weekly, 52 times a year without fail, as a best practice, the data can be as old as 14 days, and you have a much greater understanding of what's really going on with your business. And when I talk about financial reports, I'm referring not just to QuickBooks or Xero or any one of the other financial accounting softwares. Those are critical. But I'm also talking about increasingly the ability for people to utilize point of sale systems. But a point of sale system in and of itself is more of an inventory and income system rather than an overall expense and financial reporting system. So you have to use both. If you are a product-based or a service-based business that collects money through Square or any one of those other processes, you still have to utilize GAAP-based accounting, the generally accepted accounting principles known as GAAP, managed by the Federal Accounting Standards Board. I'll probably mention that a couple times because, in my opinion, you do not want to be somebody who actually has to do all the data entry yourself and to do it according to the GAAP principles. One of the things that we know through the COVID, we've learned this really the hard way, is small businesses that do not, we had many who don't even do tax returns, but for small businesses that cannot produce credible, in some cases, certified financial reports, such as a profit and loss, a balance sheet, a historic cash flow statement, an accounts receivables, an accounts payable, inventory report. People who can't produce those have a much lower chance of being able to obtain, were able to obtain any of the COVID relief plan programs, from the PPP to the RRF to the SVOG to the TEA, all acronyms that I've been working with now for the last 2 years. More than happy to dig into any of those with you. But my point here is that even the working Washington grants from the Washington State Department of Commerce, of which I've been very involved in with those and producing webinars for those, Working Washington 1, 2, 3, 4, the business resiliency grants and the border business grants that I think many of you may have been involved in with that, which was towards the end of last year. People without financial reports have a real hard time being able to get and obtain access to those funds. Huge hit for those of you, or some of, not saying you particularly, but small business owners who may not have been keeping up to date with their financial reports, which really are required. At the end of the day, one of the other questions that I ask people is, how much money do you spend at the end of the year to get somebody to do your taxes? If it's over $500, $1,000, $2,000, $3,000, that's a clear indicator that they're not maintaining financial reports on a weekly basis. And they're asking and paying their CPA to clean up their books so that they can actually even get their taxes done. Interesting, all these little indicators that go along. But one of the tools that I use as people do keep up with their financial reports, one of the tools that I use is something that I refer to as a margin management. So let's just say, as a percentage of gross revenue, and again, this can be applied to a service-based business, but this particular model I'm showing you is a product-based business. And if you're tracking your financials on a regular basis and you are tracking your margins as a percentage of the gross revenue, right? Up here, percentage of gross revenue, each of these categories. And let's just say that you're a really, really good manager of your business. Cost of goods sold might be 30%. Payroll might be 15%. These days, that probably is going up to 20 or even 25. But it all depends on how you're managing your margins and other things. If you've done a really good job with your lease or the mortgage, if you own your property and you're keeping that below 8% of your gross revenue, all other utilities, marketing, insurance, et cetera, all the other expenses that you have, maybe if you're doing a great job, that might total 63, 65, maybe even 70% or 75%. That leaves the remainder for you and debt. Notice I didn't cover you and debt in these other categories. Typically, owners' wages are not part of payroll. Even if you have managed to be figured out how to take your LLC or your corporation and apply to the IRS to have your taxes filed as an S Corp, one of those categories that you can get. You could be a W-2 employee. But the real reality is all the money comes in, all the bills get paid, and the owner is only entitled to what's left. They're not entitled to a payroll. They're not entitled to a salary. You're not entitled to W-2 wages, because if there isn't enough money to pay those things, it means that something else isn't getting paid. like other payroll or payroll taxes or your lease. And I talk with clients and have many times over the years who've fallen behind on those other things because they needed to take the money. But the reality is the best incentive of being a small business owner is to run a really good business so that you have the margins at the end to cover any debt you might have and or pay yourself. Obviously, the bad side of that is you're not a good manager. You don't keep your eye on the ball. And we've learned that those people who are really good managers more often are going to wind up closer to the good side in all the categories. And those who are really bad wind up being closer to the bad side in most all the categories. But let's just say your cost of goods sold was 50%. There are some businesses where that's the business model, means they have to do well in the other margins. Payroll 25%, lease 20%. I see this a lot. All other, insurance, utility, marketing, all other, they just buy and spend. Maybe it totals up to a larger percentage. And in which case, there is no money for you in debt. And in fact, you're feeding the business to keep it alive. Tracking your margins every single week during the time that I'm going to recommend you do this financial discipline system is real important so that you are paying attention to all of these things and know what they mean and which direction you want to take them. Most people are going to fall in between here, somewhere between the good and the bad, and are working on these things every day to help improve their buying for cost of goods sold, the managing their payroll as it relates to work hours and the people that they hire and such, negotiate really good leases, and control their spending on all the other things. Those people, most people fall somewhere in between here, but constantly have to work at this so that they can get closer to the good side than the bad side. Okay, let's talk about the financial discipline system itself. And this is really sort of a system that is essentially one that you can utilize as an example. How it fits your business is up to you. You're going to see that I recommend that you do this manually with printed records. Eventually, you would do this as a download, electronic, digital, and you may even start off that way. I do recommend that you try and do this manually on printed form first so that you recognize how the system actually works. And if you can convert it to digital, you've got to make sure that you're tracking so that you get, in this example, as you go through the week, all the business revenue and income records, customer payments, deposits, invoices, point of sale reports, right? You place these in the proverbial fishbowl on your desk. Likewise, as you go through the week, you collect all of the business expense reports, records, receipts, cash, credit, online, however it is that you spend money. Again, these should be in some kind of printed form or eventually electronic. Most of the systems like QuickBooks Online, Xero Online, have the ability now for you to actually take pictures of your receipts and post them along with the entry in the accounting system. But as a start, you take all of these records and put them in the fishbowl on your desk or the appropriate file. And then every Wednesday afternoon, as an example, everybody has to figure out how this system is going to apply to their own business. But every Wednesday afternoon, 52 times a year without fail, you take the contents to a well-established, multi-client, good reviews and references, working out of a business location bookkeeper. I know that there are good bookkeepers in the San Juans, right? We've identified several. However, because today's work is more virtual, it doesn't have to be somebody who's in the San Juans for you to get to somebody who is really willing to do this every single week. But if you look for an independent bookkeeper, it has to be somebody who is willing to do this weekly, not just monthly, right? You might pay them $50 or $60 or $70 an hour. But in my opinion, it is not worth the owner's time to be doing all of this data entry or to become a practitioner in the generally accepted accounting principles known as GAAP. I highly recommend that you avoid friends, family, and neighbors. I've met with so many clients where one spouse does the operational elements and the other one does the bookkeeping. Problem with that is that when the person doing the operations isn't bringing in enough money or is spending too much, that means that their spouse has to go back and tell them that they're doing something wrong. Usually creates tension in the family. Not worth it. You want an independent person who is consistently updated in GAAP accounting, who is working out of a business location, somebody who is, and today the business location might be a legitimate location in somebody's home. But according to IRS rules, somebody who is operating a home office business has to be doing so in a location that is used solely and exclusively for the business, or they cannot claim a home office business deduction. Another topic we could get into later, but what happens if you go to the next stage, right? When the bookkeeper gets all of this and then spends 2 or 3 days doing the data entry. From Wednesday afternoon to Friday afternoon, the bookkeeper does all that. The data has to be good and well documented. Who, what, when, how much, what for, what account, what category. If you make sure that the bookkeeper knows all of that, and this is why I recommend, at least in the beginning, not doing an automatic download into an online accounting system, and they're all built to do this now, not doing an automatic download from a bank statement, the online bank system, right? It's your bank. Because that means that the only information that you've got in your accounting system is what came from that bank account. That may not include other bank accounts. It may not include your credit cards, right?
Looks like Steve's screen sharing or something is frozen up. So, gosh, Gail, shall we hit it with something? How about if we take questions right now? Does anybody have any questions of anything that we've talked about already? Nope. Okay. Steve, where are you? Sorry, everybody. It's our new Zoom lifestyle.
I think he's dropped off altogether, Victoria.
Dropped off. Okay. So
It looks like Vala had a question, but she's muted.
Oh, yeah. Sorry, Vala.
You can unmute
Hey, there's
yourself.
a baby in there. Hi, baby.
That's why I'm muted.
Oh.
I was just curious. I've been working with Minnie Kinch at the Workforce Center in San Juan Island, and I was going on this WIOA application, and she suggested that there are scholarships for training available through the small business. Is this who she was talking? Is this the organization that she was referring to? Do you know?
It would be, I don't know. It would be worth it to talk to him and ask him. He knows about so many things due to his job that he might have access to stuff that we just don't know about. I would say for scholarships too, you could try Seroptimus. That's like a women's group.
I've already gotten theirs.
Oh, shoot. Okay. So there's also PEO. Have you heard of them?
No.
And also, so it's PEO, and then there's the American Association of University Women, and they both have chapters here.
Okay.
And
That's
they're
good
both,
to know.
yeah. And that's great that you hooked up with Minnie because she's got access to things too. Gail, that might be Steve calling.
Is that him?
Ah.
Yeah, let me see.
Oh dear. Well, you know what we could do, Gail? If he doesn't show up in a little bit, we could actually take everybody's email address and set up a second thing. Oops. And I gotta actually grab this phone call. Sorry, everybody.
And I'm gonna try to call Steve and see if we can, oh, he's back, maybe. There he is.
No, I'm on Zoom all day long and I think
Oh.
it's tired. I appreciate your sticking with me. I hope I didn't lose anybody, but.
Nope, I think we're all good. Thank you, Steve.
Yep, all I need to know is, and I think I'll be good from now on. It took me about 2 minutes to restart my computer. So where did you lose me?
We were at, we were getting into the financials.
Taking everything to your bookkeeper once a week.
Thank you.
Great.
Thank you,
Thank you.
Vala.
Let me get back onto the share screen here. And so kind of close your eyes. I'll skip through the first several slides again. Back to where I was. All right, right about here.
One more, maybe.
Yep, that's the one.
Was that the one? Okay.
Cool. So I was going to go to number 4. So from Wednesday afternoon to Friday
That
afternoon,
was it. Yes. Thank you. Perfect.
the bookkeeper does all of the data entry, but this data has to be good, well documented, who, what, when, how much, and account for, right? So, but if you get all this information to the bookkeeper, then the next step, which is where this really gets to be critical, every Friday afternoon, 52 weeks a year without fail, the bookkeeper emails, which is why you can do this on vacation, back to you a set of reports: profit and loss, the balance sheet, the cash flow statement, accounts receivable, accounts payable, inventory. You may not have all of those depending upon your type of business. And the inventory report may have to be something that comes primarily from your point of sale. But we're going to talk a little bit about one of the biggest mistakes that most people in a product or retail type of business make a mistake. And that is that they oftentimes tend to call everything that they buy to sell, they call it cost of goods sold, when it's not even been sold yet. You cannot call things cost of goods sold if they haven't yet been sold, right? That's why it's really stated that way. So we'll talk about that a little bit more in just a second. But being able to get all of these reports from a bookkeeper 52 weeks a year means that you have to engage a bookkeeper. And I stress the importance of somebody who studies GAAP and is independent, but somebody who is willing, $50, $60 an hour, and they shouldn't spend any more, for most small businesses, more than an hour a week doing the data entry. You can get this done, get all of these reports, and get it done back to you every single week without fail. Many bookkeepers would just as soon do it monthly. You've got to engage somebody who's willing to do it weekly. Now, here's where you spend the time, right? All the rest of that was just developing a system to collect all the data and get the data to an independent bookkeeper and get the reports back. But for you, every Sunday morning, 52 times a year, you take those reports and spend 90 minutes reviewing them. And then you make 2 lists. Don't spend more than 90 minutes on this. If you do, you're spending too much time. Step number 7, the first list is everything on those reports you do not understand or everything that does not make sense. And then on Monday morning, you go back into your business and you start asking questions. This becomes your education in your financials and your oversight of your business. And I got to tell you, every client that I've ever had who has adopted this system has gone and goes back into their business on Monday, maybe it's Tuesday, whatever the date that works for them, and starts asking questions about the money. Everybody that's connected, from the vendors to the customers to the employees, to the investors, to the stakeholders, everybody begins to realize that you have truly got an understanding of how your business works and what's going on. They recognize the fact that your oversight, your prevention of fraud or mistakes questionable activity, questionable behavior, right? Every system has inventory shrinkage, for instance, that has a product-based business. You can't avoid it. The question is, are you managing it at 1% of your business or 10% of your business? If you're an inventory-based business, you're going to have inventory shrinkage, right? One of the things that we know, for instance, is that anybody in the food business who gets deliveries from Food Services of America or Cisco or any one of those are all independent contractors. And they actually make their margins on those businesses that they know that don't count the products when they drop them off. How many of you have gone into a store and bought a case of water or something else and put it on the bottom of the shopping cart and wheeled that shopping cart out and get to the outside and realize you didn't pay for it, or they never rang it up, or you put 6 things down and they only ring up 5. This happens every day. You can't avoid inventory shrinkage. In a restaurant, it's food waste, liquor overpours, all of those kinds of things. So the question is, to what extent are you managing your business and having financial oversight? And doing this kind of work weekly is the only way where you can solve these problems and let everybody that's involved in your business know that you're paying attention. So that when you walk in on Monday or whatever day works for you, and you start asking questions about these things and getting other people, right, that you may be engaged with, and every business engages with other people at some level. Otherwise, you're not selling something. So when you start asking these questions or examining whether or not your systems are working very well, your business gets substantially better and more successful. Number 8, what's the second list? On this list, you write down everything that you do understand, you just don't like it. This then becomes the basis of the changes to your 12 to 24 month cash flow forecast. And I'm going to show you this cash flow forecast. But I want to preface, this is not your actuals. This is what you think is going to happen in the future, right? So this is what you think. And you start off by making somewhat intelligent predictions about this. As you get better at this over time, you'll discover that your predictions become more and more accurate, because every single week, you may not be making changes to this cash flow forecast, but you are looking at it to see what maybe needs to be updated, modified, or changed. So this is the first of 3 pages that describe this cash flow forecasting. And in the upper right-hand corner up here, I want to point out, once again, this is your projected cash flow, not your actual. But I've got some numbers in here as an example. And the first thing that we're going to talk about is, what is the beginning bank balance in the bank? How much money do you have in all of your business accounts? What is that number? Then you sell your product or your service and you develop income from operations. And you estimate what that's going to be for the month. You're not going to know this ahead of time exactly, but you're going to estimate what that is. Then you're going to identify, wait, rolling my little wheel too fast, the other cash in, right? This is other cash in from money that you put into the business. If you get a loan from something, or you maybe sell a piece of equipment, whatever other category that might be besides your member investments and term loan proceeds. So what this means is that the income, and this part here that's in sort of the orange, you wind up with the total cash from your operations. Other cash in gives you the total other cash in. The combined gives you the actual total income for the month in real dollars. Keep in mind, if you're a service-based business up here in income, I'm referring to paid receivables. When you actually think the money is going to come. So if you're a business that invoices, you invoice in February, and you know you're not going to get the money for 60 days, you estimate that income coming in 60 days later. This income portion up here in the income from operations is the income that shows up on a profit and loss sheet. This other cash in is cash that comes in and shows up on a balance sheet. So it's important to note the difference between cash as it relates to the profit and loss and cash as it relates to the balance sheet, since there's cash elements of both. On the next page here, I'm going to talk about your expenses. So this is where we start the other cash out. Advertising, marketing, auto expense, bad debt, bank charges, commissions you might pay for salespeople, contributions to a worthy cause. I want to point out cost of goods sold labor. This is the labor that is directly related to the sale. If you've got retail salespeople, if you've got commissioned salespeople, actually I shouldn't say that, retail salespeople that you pay on W-2 wages, for instance, or people who actually do the manufacturing of a particular product or the creation of a product that you wind up selling. That's going to be cost of goods sold labor. Then you've got cost of goods sold other. And cost of goods sold other is not your inventory. It is your non-inventory stuff, such as paper plates in a food service business or packaging, stuff that you might ship something to somebody online. The non-inventory stuff is cost of goods sold other. Let's go down. Dues and subscriptions, your insurance. The interest portion of a term loan is important, right? Only the interest portion is considered an actual expense. Licenses, permits, meals and entertainment, merchant fees, office, printing and postage, professional, your rent, repairs and maintenance, taxes, telephone, travel, utilities. Wages is not cost of goods sold labor. This is administrative wages, right? This is if you have somebody who's in your business who's always there handling the front end of a service-based business and handling all the administrative work, or maybe the back office work I'm talking about. That's the administrative wages. Up here, the cost of goods sold labor is labor that's directly connected to the sale of the product or the service. So down at the bottom, you've got your total expenses. And all of these expenses that I see show you here, and your situation is going to be different. Your business is going to be different. These are all the expenses that show up on the profit and loss statement. The other cash out, which is the principal portion of any term loan that you're paying. It is the line of credit payments, such as your credit cards. And this is where you purchase your inventory purchases go. So when you purchase inventory for resale, and this is even true in a food-based business, it becomes an asset on the balance sheet, not cost of goods sold, because it hasn't been sold yet. I talked earlier about managing inventory. The fact of the matter is you cannot manage inventory unless you track the inventory as an asset on the balance sheet, and you only transfer it to the profit and loss statement as a non-cash cost of goods sold item, right? Because you spent the money when you bought the inventory. You transfer it to the profit and loss as a non-cash item only when you sell it. What that means is that you know what you have sold, and you know what you should also still have on the shelf to be sold, so that if you ever do an inventory, you know what should be there. And then the difference between what's actually there and what your book inventory on the balance sheet said you had is the inventory shrinkage. That's the only way you can mathematically, from a dollar perspective, track inventory shrinkage. If you aren't doing that, you're not managing your inventory, and you have a potential big hit going on in your business. So now you've got the other cash out. Then you take the total expenses on the previous slide, along with this total cash, other cash out, and you have the total cash going out for the month. Then you had, if you recall, the total cash in for the month, and you subtract from that the total cash out for the month, and you get the ending cash position for the month, right? Hopefully, there is more cash, ending cash position for the month is a positive number, right? Then you have the beginning bank balance that I showed you on 2 slides ago in the far upper left, the actual cash in the bank, less the differential for the ending cash position, and you have the ending bank balance, right? Now, this is what you believe is going to happen. What we recommend you do is you use all of the, populate what you believe all of the other cash out items are going to be, including all of the expenses. And when you do that, then you can go back and figure out how much money you need to bring in so that you cover all of your expenses, all of the other cash out, and there's a positive ending bank balance in the bank. And what that really means is that this is the amount that you're entitled to. Because as I said before, all the money comes in to the business bank account, all the bills get paid, and the owner is only entitled to what's left over. This is your incentive to run a good business and manage your cash flow forecasting this way. If you do this, you'll discover that it's pretty easy to learn about your business, understand what's going on, get past the point where you need to check your bank balance every day. Easy to do on your phone. But if you're getting these reports and you look at them every week, you know what's going on. You're on top of it. You don't have to manage it based upon how much money is in the bank, one of the primary causes of failure of a small business. So let's talk about the actual steps. As I'd mentioned, you estimate and populate the accounts and the line items for a full 12 months ahead based on your past history and your desired results. You also double check your math and formulas. This is the easiest spreadsheet. A lot of people ask us for a spreadsheet template. I prefer not to send that because it's not going to fit your business. You can't rely on the formulas in it. You've got to modify and build a spreadsheet. And if you don't know how to work with a spreadsheet, contact somebody who does, who can help you. But it's up to you to build this because at the end of the day, you're the only one in charge of your business. Be sure the beginning cash balance in the bank is the true number in the first month. At the end of the month, note the calculated ending cash balance that you thought was going to happen vs the true ending cash balance in the bank. You're going to discover, certainly for the first year or longer, that you're off. But as you get better at paying attention to this, you're going to get so confident in your business that you're going to be calculating a positive bank balance, and your estimate, your forecast is going to be within 1 or 2% of itself, of your estimation in the actuals. So then you put the true bank balance into the beginning cash balance of the new month, right? So that what you start off the second month or the third month or whatever is the next month with the true bank balance at the beginning of that time. And then of course you discover, as I mentioned, that the ending cash balance at the end of the month does not match. Your job is to become the Sherlock Holmes of your business and research and discover why your forecast did not match the true bank balance, and then you make changes to your future forecasts. Open up a new month out so that you always stay at least 12 months ahead. The people that I work with on this are doing this 24 months ahead and are very confident about what their business is going to be about 2 years later. The reason for review of the financials: primary defense against fraud, the best basis for investigating issues, the ability for you as the business owner to manage and tweak all the systems, and it's the basis for strategic planning for your business. You have to hire a bookkeeper, as I'd said, who's willing to do weekly, 52 times a year, cycle and process data input and produce the reports to you. Designated each day, the bookkeeper emails the reports. Manual posting at first, electronic, then review of the accounts and assignments is required. Timely responsiveness to emails and inquiries, and view only access to bank and card accounts. So that's the financial discipline system, all the steps to it. I've sent this PowerPoint to Victoria. She can distribute it to all of you. I believe that despite my interruption there, that we're continuing back to the recording. So feel free to look over this again. And if you've got any questions, and you want to reach out to us, the fastest way to get to one of us here at the SBDC is to send an email to washington@wsbdc.org or 833-492-7232. We've got a whole team doing intake as part of our Center for Business Resilience, and they are standing by to get an email and refer you to the most appropriate business advisor who can help you with whatever it is you're working on or about. I may have missed some of the chat questions when I restarted, logged off and logged on, but let
Yeah.
me see.
Oh, can you see them, Steve, or do you
Well,
want me to
I've
read them
got the
out to you?
last two.
Okay, that's all we had were two, so that's
Okay,
great.
good. So when you purchase inventory resale, where does the shipping cost go? The shipping cost is actually going to be one of the expense items, right? Because you don't typically recover that. So you're going to cover this somewhere in office expense, professional fees, right? Any one of these, you can make it, you can add a category in here and call it shipping, but that's just a cost to you for shipping. You've got to make sure, and I don't cover it in this presentation, but we do another presentation in which we actually talk about how to mark up a product, right? A lot of people think that if they want to mark it up by 30%, they just multiply it by 1.3. You will never get ahead doing that, right? You actually, there's a division that you have to do to be able to get the true markup so that you've got a 30% markup or a 100% markup or a 50% markup of whatever it is. We can teach you how to do that process if you'd like. If you find an issue mid-year, do you readjust the remaining months? Listen, the reason why you do this weekly is you readjust and you make changes as you learn every single week. You don't wait to the mid-year, right? You do this every single week. You improve this forecast. At the end of each month, you open up a new month all the way out. But you don't necessarily, you don't wait till mid-month, mid-year. You do this every week. You may not actually make changes, but you want to do it every week. Reach out to me, Felicity. You can send an email. I can put my direct email in the chat if you'd like.
That would be great. Thank you.
Yeah, but I can actually get you that information. It's pretty good. Although this is commonly available, you can actually Google how to do how to mark up products, and it gives you the entire math formula on how to do it.
Great.
More questions? Anybody want to just raise one while we're here? You're all on. Have I all got you committed to doing financial discipline now?
Yes. I think it's a real eye opener. I have a small business myself, so it's when I took this webinar the first time, Steve, it was just a real eye opener to me of how things I need to do to improve. So yeah, I think it's really, really informational. Also, I was wondering maybe perhaps we could do another webinar on pricing if you think, or something like that, if we think there's an interest in that.
Yeah, the webinar we've been doing, let me give you another thing that you should look up to. We do monthly webinars that you should really look into. I'm going to give you the link to get to those. If you follow this link, you are able to find webinars that we have done on demand, right? So that these are webinars that we've done in the past, or webinars that we have scheduled live coming up.
Okay.
So you can sign up for these there. You can, it does require you to do a little quick sign up with us as a training client, which is fairly common. But we'd be delighted to have you. We do one called Growth and Development in an Era of Recovery. If you go to that, you'll see it. we can, you'll be able to find the fact that where we cover that markup system, and you can certainly attend that. I might be able to even tell you when the next one is.
Felicity also had another question. Can you see that, or do you need me to read it to you?
I can see it.
Okay.
Let me see. March 1st, my colleague Ron Nielsen and I are doing business growth and development.
Oh, great.
1
Okay.
o'clock on March 1st. And that's when we're going to cover this whole markup. How do you actually do the math calculation? So if you can wait
Great.
that long to study that, by all means, go to this link here and you can do it. So Felicity, if you want to sell your business in 3 to 5 years, what financial systems do you recommend besides these financial systems? Well, I would go back, quite frankly, to the identification of the things that I brought up in the slideshow. And I'll get back to that where that is. And I know I'm not showing it at the minute, but let me figure out which one that is. I'm going to show this to you. So it's not gonna, that's funny. Now that I'm on that, let me move back here, hang on. So these are the things that you want to do, Felicity. You want to sell and you want to actually generate some money from it. You've got to be somebody where anybody looking at your business realizes that they don't have to be in it every day, that you are somebody who doesn't have to be opening the front door every single day and closing it up and doing all of the work yourself, that you have built a business that focuses on all of these things that I'm going to talk about, so that it's obvious that you're working less than full time. There's a consistent growth and a well-established history that shows that your systems are working. So over the next 3 years, can you have consistent growth? This is true even in a recession. Businesses that are really well run may be flat during a recession, but only those that are truly chaotic or are subjected to total whims, right? If your business in the San Juans is based entirely on tourism and tourism stops, you want to pivot your business into something that's a little more stable on a year-round basis, right? To actually make it valuable down the end of the road, as an example. So a consistent growth and a well-established history. Diversified customer base, the things that you produce and sell, service or product, appeal to a lot of people, right? It's not a narrow niche, right? It's a niche service or a product, but it appeals to a lot of people. Another one where there's a limited reliance on any key employee means that you are really good at human resource management and leadership. People like to work for you. You know, today in the Great Resignation, when it's hard to find people to do the work, one of the things that I can tell you is that I've got many clients who are putting an ad in Indeed and are getting dozens of employees for any one position, because Glassdoor, they've got great reputations. They've got a great reputation as being a good business owner and a good business leader, real strong sustainability. So having a good human resource management, being a good leader, but also having a limited reliance in the way in which you build your system on that key employee. There's always somebody there to help back them up if need be. And if they get sick or for whatever reason can't show up to work, you can move other people into that category or hire people who can learn your system and fit into it with only a marginal drop in your business, if any at all. Developing trade secrets. Any business can have developed systems that it's hard for somebody else to replicate. That's why we talk so much about systems. If you develop systems that are hard to replicate, then you have some trade secrets. It may not be patents, copyrights, or other trademarks or intellectual property per se, but they are trade secrets that really is the way in which you have crafted your successful systems to market real well, right? To manage that business very well. And then last, but certainly not least, you have to have a system to make sure that you collect all the money. Most product-based businesses today that use a system like Square, great, right? You're collecting most of your money right up front. But the next part about the inventory and the inventory management and understanding that the inventory on your balance sheet isn't cost of goods sold until it's sold. So you are actively managing your inventory. Your point of sale system tells you what's sold. Your balance sheet tells you what's still on the shelf. You do a regular inventory count. You identify what the difference is. You know how much has been missing due to inventory shrinkage, right? So you know what should have been on the shelf. You know what is on the shelf. You know how much you've sold. With those three factors, you can determine what the differential is and how much money you spent for product that you never received income for, or you still have on the shelf. And if you can manage your inventory that way, and you can determine where the problems are in staff training, in receipt of vendor supplies, in your buying of stuff, all of those things that where mistakes can be made, you can then improve and recognize and identify where the mistakes were and make efforts to improve them so that you reduce the amount of inventory shrinkage. And then number three, most important of all of these, if you want to sell your business and get real money for it, is not having to manage the business based on how much money's in the bank. That's a direct indicator of a weak business, one that may, in the end, not survive very long because you don't have a system in place that I refer to as financial discipline to develop the financial reports. Okay, next question, Valia Walker. That's a really good one. So let me point out to you that sales tax received and paid does not go onto any financial reports other potentially than the business, than the balance sheet that tracks your assets and your liabilities. So the cash is going to get tracked from sales as a sales tax account on the balance sheet, but it's also immediately a liability, right? So the truth of the matter is that sales tax, and I deal with clients all the time that make this mistake, sales tax is not business income, right? It is not business income. Did I ever share that screen?
I don't think so, Steve.
Oh, the one that I was on. And I kept going, should have gone going. So funny how it's never, I don't always know when I'm pressing the button or not, but the factors that demonstrate a business of value,
yeah.
publicity, right? And then the biggest causes of failure of a small business. So,
Yes.
right. So point though is that sales tax is money that's not yours. You're holding it in trust for the state. So it is completely off books, right? And in fact, our recommendation is that you sweep from your point of sale system the actual sales tax plus your B&O tax, right? That the state may want. And if you've got employees, your payroll taxes, every single week, you sweep that into a separate savings account. You can't touch it. If you're in trouble financially, don't touch it. I have taken clients into the Washington State Department of Revenue office here in Kent, right next to where I'm in Tukwila in Kent. And on the wall, this is a true story, on the wall, when you go into that office, they have little pieces of paper tacked up covering an entire wall of all the businesses they've closed for failure to pay the sales tax because they used the sales tax as income and didn't recognize that it was due to the state. to move that into a separate account. And then when you file, if you're doing it quarterly or monthly, whatever the OR is requiring of you, you actually then use that savings account to have the money withdrawn. Same when you're doing your 941 for your employees. You have it drawn from that account. So you make sure that all of those taxes that are going to be paid to federal or state purposes are set aside in a separate account, and you cannot touch them. It's not your money anymore.
Hmm.
Good questions.
Mhm.
Any more?
Vala, did you have a question you had when we lost Steve for a few minutes? You had a question on if he knew about any scholarships? I can.
Yeah, well, I was working with the workforce organization and exploring worker retraining opportunities. And they suggested that I follow up with a small business application for training in a new industry. And I was just curious if that your organization, Steve, and if there's a link that I can get for more information about training opportunities.
So the program is called SEAP, which is Self-Employment Opportunity Training, I think.
Yeah.
We're authorized to do that, but only for the workforce organization that's down here in Federal Way and Des Moines.
Okay.
You want to go to your workforce development organization and find out where you can get that training, right? What I can tell you though is that if you're just trying to start a business, and I don't know where your nearest SCORE representative, but SCORE is a program of retired executives that really help people just get businesses started. And I would try and find a local SCORE representative. There probably is one in the San Juans.
Mhm. Yeah.
And I would contact that SCORE representative and say, look, I want to start a business. And they might be able to, SCORE, by the way, doesn't charge, neither do we for our services, but you can get that training from them that might then help you obtain that unemployment if you can then certify that with your workforce development.
Mhm. Yeah, Vala, if you want to email me or call me after this is over, I can hook you up with our SCORE rep.
Thank you.
Mhm.
Great questions.
Yeah, really great questions. Anybody else?
Well, you got me. Well, if there isn't anything else, I want to just say thank you all for hanging in there through my computer interruption. I'm glad you stayed on. Feel free to share the recording however you want. And Gail or Victoria, you have the slides and feel free to share those. So
Thank you very much. We
anybody
really,
wants
really
to-
appreciate it.
you bet,
Appreciate all the
everybody.
advice. Thanks.
Yes, you bet. And I wish you the best. I really knocking on wood here, hope that that we're almost to the end of COVID and we can get back to some sort of a new normal, or at least begin to predict what the new normal is.
Mhm.
And we can do that here sometime as we progress through this year. I'm truly looking forward to it. So.
Okay, thank you very much. And yeah, if anybody wants a copy of the deck, just let me know and I can email that to you as well. And thank you very much, Steve. We really appreciate your time.
You bet. Take care, everybody.
Thanks, everybody.
Bye-bye.
Thanks for coming up. Thanks. Bye-bye.
Bye.